Hello everyone and welcome back to the world of finance. Now in this session we are going to start with a series of discussion on a very important topic in finance, that is about exchange traded funds, ETF. So it has been as a matter of question in everyone's mind, what is ETF? What is an exchange traded fund? How is it operated? What is the mechanism of exchange traded fund? Who are the parties involved? How it is managed? What are the advantages of exchange traded funds? Let us clarify each of these aspects in as much detail as possible. So this is going to be a big discussion, so I have broken this discussion into multiple parts for your convenient viewing. You watch one part at a time, and just once you are done with that particular part and you have found yourself comfortable with that, then you move to the next part and so on. So imagine that you are thinking of investing in stocks. Trading for an investor in a stock market is extremely convenient. You just need to have the rightful analysis and you can just trade at your convenience. It is so easy to trade in stock exchanges based on the current scenario worldwide, the kind of stock markets and their efficiency, what we find in terms of operation. It's at one click of finger, you can buy and sell stocks of companies. On the other side, if you look into a particular market index, I have seen investors generally discussing that stocks may perform good or bad, but generally if the economy is good, the index always keeps on growing. So some investment managers or some portfolio managers, what they try to do is they try to replicate the index. Any particular stock index they will pick and they will try to replicate by creating a replica portfolio. Basically, if you have heard of index funds are predominantly the funds which are a replica of index. Now what happens? What if I tell you that you get a hybrid product which is giving you benefit of both the worlds, means the efficiency of an index fund and the comfort of trading of stocks in a stock exchange? Won't it sound exciting for you? Yes, it is. So exchange traded funds, as the name says, exchange traded. So these are investment funds which are traded like stocks in a stock exchange. So you get the benefit of the index fund type in terms of the performance, and you get to take the complete convenience of buying and selling units of such ETFs in a stock exchange, and that gives you benefit of both the aspects on one go, or I would say in one plate you get double advantage. So basically, what exactly are exchange traded funds? I will put forward that definition over here on screen, and at your convenience you write up these notes as well. So let us first define what are exchange traded funds. An exchange traded fund is a type of investment fund and exchange traded product. So basically it is an investment fund as well as an exchange traded product, meaning they are traded on stock exchanges. These are hybrid products that combine the features of listed stocks and index fund. ETFs hold assets such as stocks, commodities or bonds and generally operate with an arbitrage mechanism designed to keep trading close to its net asset value, though deviations can occasionally occur. These funds are listed on the stock exchanges and their prices are linked to the underlying index. So please write up this part of the notes and then I take you ahead. Alright friends, once you have completed writing this whole thing, let us move ahead and now talk about the most important characteristics of exchange traded funds. The first characteristic, it is offering you diversification. Now, how diversification? Understand one thing, when you are investing into an index fund or say an exchange traded fund, of course index funds are little different. Here we are focusing on exchange traded fund, but the pattern of the structure of the fund is similar to that of an index fund. Therefore, I am giving constant reference to an index fund as well. So what happens, because the way an index fund is diversified, the way the index itself is diversified, that diversification advantage you get in this kind of exchange traded fund. So what happens, you don't have to sit and manage a portfolio. You don't have to create assets from your analysis. Some experts have done their analysis, they have created that fund, they have created that replica. You just need to buy some units of that, as many units you want to buy depending upon what is your investment requirement and what is your investment objective. Now, so diversification is one big characteristic. Tradability, another characteristic. Now what happens, when you are finding it convenient to trade these units, that is units of exchange traded fund in a stock exchange on an ongoing basis, that means as long as the stock market is an active operating hours, you can buy and sell the units of exchange traded funds just like you are buying and selling the shares. So the way you trade on stock exchange with stocks, taking intraday positions, you can do the same thing with respect to ETF as well. So that kind of tradability is yet another important characteristic of exchange traded funds. Transparency. Now what about transparency? See, certain portfolio managers may not be so transparent about where they are investing your money. On the other side, ETFs provide transparency in terms of what all they have included in the portfolio, in terms of an investment portfolio, what structure has been created, what is the investment profile, and the complete information is passed on to the investor. And most importantly, yet another characteristic which is a big advantage as well for the investor, because the fund management fee is not very high. Now why fund management fee is not very high, that also you need to understand. See, imagine a separately operating mutual fund. What happens, the mutual fund may not be a kind of replica of any particular index. So what happens, there the separate team of analysts will have to sit and operate. Not only about analysis, even the operation of the fund has to be on a regular basis. Now what happens, mutual funds which are mostly open-ended funds, you definitely know the meaning of open-ended funds. Open-ended funds where the fund operator or the asset management company can issue new units and redeem existing units as per the requirement of the investor and as per the need of the fund to fulfill the fund objectives. So units of mutual funds are not traded in stock exchange if it is an open-ended fund. So at what price a mutual fund unit can be bought or sold? It is based on the prevailing NAV at the end of a particular day. So what is the prevailing NAV? On that basis, the buying and selling of mutual fund units happen, particularly where the mutual fund is an open-ended fund. That doesn't mean that exchange traded funds are closed-ended. Exchange traded funds may or may not be closed-ended. Generally, exchange traded funds will be found as open-ended funds, but it is not so open that anyone can directly subscribe to the issuer for taking new additional units in between. I will be talking about the participants in an exchange traded funds in detail after a while, but understand that it gives you the benefit of open-ended scheme of a mutual fund but parallelly giving you advantage of tradability in stock exchange, and because there is no specific need for redemption on ongoing basis to the general public which is investing in the exchange traded fund, the fund operation effort and cost is less, and therefore the burden of the fees that gets on or gets passed on to the investor ultimately is also substantially lower. So I'll give you some time to just take note of this whole thing, and then I take you ahead. Alright friends, once you have completed writing this whole thing, let us move ahead and now talk about the basic mechanics, units of ETFs. Now what exactly do we mean by units of ETFs? As the capital of the company is divided into small units that we talk about as shares. So exactly that way, the mutual fund or exchange traded fund have the division of the fund ownership in units. Now these are even referred to as shares. I would strongly avoid the usage of the word shares, because understand, anyone can get confused when you talk about shares. For example, suppose I am an asset management company and there will be some equity investment in my company. That means some equity ownership in my company. Those investors are the shareholders of this company. I hope you are getting my point very clear, that the ownership of the entity which has issued the exchange traded fund, that ownership will be divided in number of shares. That is what we call as shares of that company, which is part of the share capital of that company. Therefore, the ownership of company is obtained when you buy the shares of that company. Here you are not buying the shares of the company. Here as an investor you are buying the units of the fund operated by that company. That is why for mutual funds, exchange traded funds, index funds, we generally don't call the each individual unit as a share, but we necessarily call it as unit. So in most of the textbooks you will be finding the word shares also given just in parity with unit, but I will try to avoid that term throughout. So keep that thing in mind. We will always prefer calling it as a unit of an exchange traded fund. So basically the way share capital of a company is subdivided into small fractional ownership, which is called as a share, the ownership of an exchange traded fund is divided into small units, and these are typically referred to as units of the exchange traded fund. So if you own certain number of units of that exchange traded fund, means you are having participation in the ownership of that fund. You are owning not the entire fund, but the portion of that, a specific portion of that. So if you want to invest in very small value also, you can frequently and easily do it in stock exchange. The way you make small investment in shares, you can make small investment in ETF. ETF investors can make investments in large value or small value, completely depending upon the flexibility of their investment objective. Now here flexibility is therefore one very important feature of an exchange traded fund. So I have just talked about the units of ETF. Now talking about net asset value. Just like a mutual fund, where the price of that mutual fund is its NAV. Again and again, when I refer mutual fund, I am necessarily talking about the open-ended mutual funds. So the pricing of units of mutual fund is its NAV. But NAV is not computed on moment to moment basis. NAV is computed on daily basis. So at end of the day, the NAV will be computed. Same process applies in the exchange traded funds as well. But the big difference is exchange traded funds are not traded at NAV. They are traded at the price quoted in the stock exchange. Means the market price or the quoted price which can fluctuate every moment just like stock prices in the stock market. Exactly that way, the market price of the ETF can fluctuate. Best thing about ETF is its arbitrage mechanism is designed in such a way that the fluctuation or the deviation of the price from the NAV will be extremely low. If there is a big deviation, there will be a big opportunity for the participants to arbitrage in this fund, and they will try to balance out the price. They will try to bring the market price close to the NAV. That is one important feature. Again, we will be discussing that part as well in detail. But you please understand one thing, that between mutual funds and exchange traded funds, if I differentiate, one thing that we find as common, NAV for both of these funds are determined on daily basis. What is net asset value? Net asset value is the total money invested in the particular fund. That is the total of all the market values of stocks, bonds and other securities held by that fund minus all the liabilities. So the assets held by fund minus the liabilities, which give you the net asset value, that divided by the number of units of that fund will give you the NAV per unit. So NAV per unit, the way it is determined in case of a mutual fund, exactly same way it is determined even in case of an exchange traded fund. But the big difference between a mutual fund and exchange traded fund is the units of mutual fund are traded based on the NAV and they are not traded on stock exchange. You want to buy units of a mutual fund, you directly buy from the mutual fund company. You want to disinvest, you want to sell out your units, you get the units redeemed through the asset management company, that is the mutual fund company directly. Here, once the issuer of exchange traded fund has issued the units, just like an IPO, rather I will not call it as an IPO, it is an IPO. So initial public offering will bring these units into the market, but thereafter the trading of these units happen in stock exchange exactly the way shares are traded, and therefore the trading of these exchange traded fund units do not happen at NAV, it happens at its market price. So what is NAV and what is market price, and the fact that the market price of ETF will be very close to its NAV, all these factors you need to consider. So let us write up these points and then I take you ahead. Alright friends, once you have completed writing this much, let us move ahead and continue writing further. In terms of an example, if an ETF tracks the S&P 500 index, it will hold a portfolio of stocks that mirrors the index, aiming to replicate its performance. So that is why what we can conclude further is ETFs are hybrid products that combine the features of listed stocks and index funds. So in the early part of the class, I have already explained to you that you get benefit of both the worlds together. Convenience of trading into stock and the performance of an index. Both benefits if you are getting in one go. Why would you want to invest in shares on your own when you can invest in an exchange traded fund? Why not to take advantage of both the worlds together in one go? So just write up these notes as well and then I take you ahead. This description captures the essence of how ETFs function by highlighting their unique combination of characteristics from both stocks and index funds. This hybrid nature allows ETFs to offer the best of both worlds, that is the diversification and low cost of index funds combined with flexibility and liquidity of stocks. So please write up this whole thing and then I take you ahead. Alright friends, now once you have completed writing this whole thing, again and again focusing on this very important line, that ETFs are hybrid products that combine the features of listed stocks and index funds. I would want to explain to you how they are acting like stocks and how these are even acting like index funds. Let us go deeper into this. Like stocks, ETFs can be bought and sold on stock exchanges throughout the trading day at market prices. This is a very, very important line, that you are trading at market prices and you are trading on a stock exchange. That is why it is known as exchange traded fund. They provide intraday liquidity, allowing investors to trade ETFs just like individual stocks. Investors can use various order types, for example, market orders, limit orders, stop loss orders when trading ETFs. Now, I am sure I don't have to explain to you these basic things which are stock market terminologies, that what are limit orders, what are market orders, what is a stop loss, how to place a stop loss order, and so on. So, what you can do with stocks, exactly the same things you can do with ETF. That is why it is kind of taking complete advantage of flexibility and trading into stocks. Now, what happens? Stocks will have trading convenient as well as it offers flexibility. Any stock, it will offer flexibility depending upon the trading volume. Now, I would say over here, irrespective of the trading volume, ETFs will give you flexibility anyway. If trading volume is not seen on a particular day, you want to buy the units of ETF, there will always be a seller available. These are basically market makers. And what is the role of a market maker? I am going to discuss that in detail, and that is something that is very, very interesting to know and learn about ETFs. Anyway, right now my focus point is to tell you how the ETF is taking the advantage of both stocks and index funds. So, what I have just mentioned was about the stocks. Let us now see how does ETF take the advantage of index funds. So, like index funds, many ETFs aim to track the performance of specific index, providing diversified exposure to a broad market or a specific sector. Most ETFs are passively managed, meaning they aim to replicate the performance of an index rather than actively seeking to outperform it. ETFs often have lower expense ratios compared to an actively managed fund similar to index funds. So, you would see that through these all pointers, the characteristic of ETF is very close to index funds to the extent it is having advantages of the index funds. So, please write up all these points and then I take you ahead.